Well, the US Federal Reserve has held rates steady at a 22-year high for a third straight time, signalling hikes might be over, but cuts may be on the horizon. That will mean a boost to our markets today. So let's bring in the independent analyst, Evan Lucas, for his thoughts on this. So first of all, Evan, your thoughts on the decision by the Fed Reserve today?
I think the thing to look at there was not just what you just said around the rates on hold. That was expected. It was more what happened inside the dot plots. And that's the fact that they, over there, show every single one of their voting members and their intentions and the non-voting members about where they think rates are going to be at the end of this year, next year, 2025 and 2026. And the big shift from them is the consensus now from the Fed is for 3 rate cuts in 2024 and up to 6 by the end of 2026. They also openly said, and Powell is still talking as you and I speak now, that they discussed rate cuts in 2024, openly discussed it. So all of that has been taken that they are done. They are obviously at the peak and that inflation is going to get to target sometime early in 2024. And it put an absolute rocket, not just under the markets that you've alluded to. So the Dow is on track now to close at a record all-time high. The S&P is going to be about 1% away from it. But it's more about the expectation from the market for rate cuts. They now think there's an over 100% chance of 4 rate cuts in 2024 and a chance of 5 at 83% off the back of what's happened. Yes.
So does that show that they were worried about crashing the economy, Evan?
They are. Not only that, they wanted to point out very clearly that forecasting, and we need to say the same thing for here in Australia, has been really poor over the last sort of 5 years. Now, they don't say that about themselves. They do say it about the whole general sort of population of forecasters. But that also needs to be pointed out that, yes, what they're probably alluding to is that there was expectations of a recession in the US this year. It hasn't happened. In fact, they've had a stronger year than anybody forecasted, even the most hawkish of members over in the States. That next year's expectations also could probably will be wrong. They normally are. But in saying that, you're right. What the market is saying right now is that the handbrake is on so hard that it could crash the economy, that the Federal Reserve is going to really get worried about it and have to release much faster than their forecast.
So what lessons should we be learning about that here, Evan? What's the impact?
Yeah, and that is the correct thing to be thinking about. The lessons here, has the rate hike that we had in November, was it even needed? Like, that's going to be the first question. The second one is whether or not we were A, too slow, and B, too hard at the back end of trying to play catch up. So do we see a very rapid slowdown in the first 6 months of next year? There's every chance of that. And I think you need to look at, even my EFO last night showed you the amount of tax take that's coming out of your pocket and my pocket, the amount of tax take that's coming out from businesses. Then you look onto the other side and have a look at the overall business growth. It is slowing to the slowest rate we've seen since COVID started. So all of that is probably the answer. Yeah, maybe we've done too hard as well.
Okay, yeah, I don't think that last rate hike was needed, but there you go. Evan, good to have you with us as always. That's fascinating, isn't it?